Have you ever spent an entire weekend showing homes, only to discover that the buyer never completed a full pre-approval? Or they were approved, but not for the price range they had been searching in? Or you got them under contract and discovered that part of their income couldn't be used, their cash was short, or that property's payment was too high? A pre-approval letter is important, but it doesn't always tell the entire story. This isn't about interrogating buyers, disqualifying people, or turning realtors into loan officers. It's about applying the same process to every buyer, identifying concerns early, and bringing in the right professional when something needs clarification. As both a realtor and a mortgage lender, I've seen one overlooked detail change an entire transaction. Today, I'll walk you through the conversation I recommend having before scheduling that first private showing. Let's get started. The first question I ask has nothing to do with credit. I want to know, why are you buying? And when are you hoping to move? Are they relocating, approaching the end of the lease, looking for more space, buying an investment property, or are they only beginning to explore their options? Their motivation and timeline help you understand how to guide them. Someone hoping to buy next year should be handled differently from someone whose lease expires in 30 days. You should also ask, do you currently own a property that needs to be sold? Are you already working with another realtor? And have you signed a buyer representation agreement with anyone? These questions help you understand where the buyer is in the process without pressuring them or making assumptions. You're simply determining their situation and the most appropriate next step. This is probably the biggest mistake I see realtors make. They ask, are you pre-approved? The buyer says yes, and the conversation ends there. Instead, ask a few follow-up questions. Who is your lender? Did the lender pull your mortgage credit? Did they review your income and assets? If you're self-employed, did they review your tax returns or bank statements? Did they discuss your loan program, down payment, estimated cash to close, and your monthly payment? Or was this simply a 5-minute phone conversation based on information the buyer provided verbally? Not all pre-approvals are created equal. Some involve a detailed review of income, assets, employment, and credit before the letter is issued. Others are based primarily on information the buyer entered online or provided over the phone. That doesn't mean the realtor should review financial documents or interpret the lending guidelines. The realtor identifies the questions. The lender verifies the financial information and applies the loan guidelines. If something hasn't been fully reviewed, the next step may be a quick conversation with the lender before you begin scheduling showings. That protects your time, but it also protects the buyer from falling in love with a property that may not fit their finances. Most realtors ask what a buyer does for work, but how they get paid can matter just as much how much they earn. Is it a straightforward salary? Or does their income include bonuses, commission, overtime, self-employment, or another type of income they want considered? You don't need to determine whether that income qualifies. You simply need to recognize that it may require additional review. I once worked with a buyer who was counting on an annual bonus to qualify. Based on the buyer's total income, the numbers appeared to work. But because they hadn't received that bonus long enough under the loan guidelines, it had to be excluded. Their purchasing power dropped considerably. Debt can create the same type of problem. Ask whether the buyer has car payments, student loans, credit cards, personal loans, or debts they co-signed for. I've also worked with buyers who increase their purchasing power by strategically paying off certain debts. But the decision should always be reviewed by the lender first. Paying off debt may improve qualification, but it can also use money the buyer needs for closing costs and reserves. The goal isn't for the realtor to solve the qualification issue. The goal is to identify the variable early enough for the lender to evaluate the options before it affects the transaction. One of my favorite questions to ask isn't, do you have enough money to close? Instead, I ask, how much money have you set aside for this purchase? There's a major difference. The buyer may be thinking only about the down payment, but their total cash requirements may also include closing costs, the escrow deposit, inspections, the appraisal, and reserves. Understanding their cash position isn't about disqualifying someone. It helps you understand how the transaction may need to be structured. If I know cash is limited, We may need to consider seller contributions towards allowable closing costs. We may negotiate repairs differently. The lender may identify an eligible gift assistance program, lender credit, or different loan structure. I've worked with buyers who didn't have enough cash to complete the transaction based on the original numbers. That didn't mean they couldn't purchase the home. It meant we needed to negotiate and structure the transaction more carefully. However, seller contributions have program limits and cannot automatically replace a required down payment, minimum borrower contributions, or required reserves. That's why the lender must confirm the final structure. Instead of focusing only on the buyer's maximum purchase price, ask, what monthly payment are you comfortable with? The payment may include principal and interest, property taxes, homeowner's insurance, HOA dues, and potentially special assessment. A buyer may be approved for $500,000 and still not qualify for every $500,000 property. For example, if the lender estimated a $300 HOA payment, but the actual property has a $700 HOA, the buyer's payment and qualification can change significantly. Property type and condition can also affect financing. A condominium may require additional review. Certain property conditions may create appraisal or loan program concerns, and insurance costs can vary substantially from one property to the other. Before showing a property near the buyer's limit, confirm that its expenses, property type, and condition appear compatible with the financing. You aren't underwriting the property. You're simply identifying when the lender should review the exact numbers before the buyer makes an emotional or financial commitment. After this conversation, most buyers will fall into one of three categories. They're ready to begin, they need clarification from the lender, or they need a long-term plan before they start seriously viewing properties. If they're ready, move forward with confidence. If something needs clarification, bring in the lender before scheduling multiple private showings. And if they need more time, create a plan and continue nurturing the relationship. Slowing down isn't the same as saying no. Sometimes it is the most responsible way to help someone reach their goal. A pre-approval is important, but it isn't the entire buyer readiness process. The best realtors don't attempt to underwrite their buyers. They know which questions to ask. They recognize when something needs clarification, and they involve the appropriate professional before the issue becomes a problem. A consistent buyer vetting process protects your time, sets better expectations, helps you negotiate more strategically, and gives your buyer a much better experience. I've created a buyer vetting checklist based on the process we covered today. You can use it during every new buyer consultation so important questions don't get overlooked. If you'd like a copy, comment checklist below or send me a message and I'll be happy to send it to you. If you found value in this video, don't forget to like, subscribe, and hit the notification bell. Thanks for watching, and I'll see you next time.